In 2021, I watched over $1 million vanish because I didn't have a proper plan to exit the market. In 2024, I also round-tripped a significant amount again. Although I did better that year than 2021, I still didn't maximize my gains. So today, I'm going to show you the exact framework that I'm using this time around to actually lock in my gains this cycle, because everyone talks about when you should buy, but for some reason there's this stigma about when you should sell, even though that's such an important concept to master in crypto. In markets in general, it's not about what you make, it's about what you actually keep. At the end of the day, that's the only number that ends up mattering. So I did an exit plan video a few months ago, but I wanted to do an updated version today because a lot has changed. We've had a significant run up on Ethereum, Bitcoin, altcoins, and also my thinking around my exit strategy has also slightly changed. In fact, I'm already starting to implement some of the stuff that I spoke about in last video. So I thought I'd do an updated full strategy for you today to help you make sure that you lock in your profits this cycle. So before I give you the exact exit plan, let's firstly talk about some of my mistakes in the past. The first mistake was last cycle, I got attached to arbitrary numbers. So I was obsessed with the thought of Bitcoin going to $80,000. Now, of course, it went to $69,000. And because I had this price target in my head, I didn't actually sell, even though some of the top signals were starting to emerge in the market. But ultimately, the market didn't care about my number. It didn't care that I was 10K off my price target. So naturally, I fell short and ended up round tripping a lot of my gains. And it's the same for your portfolio amounts as well. If you're targeting a $50,000 portfolio, but you get to 47K, well, the market could easily round trip before you have the possibility of actually hitting your price target, which makes price targets in crypto not a very effective strategy in my opinion. This time around, I'm taking my learnings from 2021 where I became a millionaire and then ended up round tripping back down to a couple 100K, and my lessons from 2024 where I've had multiple big losses which are publicly documented. One was 1.7 million, another one was a few million, and I'm combining all of these lessons with the current meta in the cycle, and I've used this to put together today's strategy. Now, before we get into the strategy, I want to let you know that I have a free Telegram in the description below that I'll be using to update you day to day, because I understand some people could be watching this framework in weeks or months from now, and the market changes every day. So when there are times where I decide to de-risk a portion of my portfolio, I'll be letting you know there in a time-sensitive manner. For example, yesterday, I took some profits on my portfolio. I went into the Telegram and updated you guys on that kind of stuff. So when some of my exit triggers from today's video actually hit, this video is a great overall framework, but for the actual signal, you want to be in my Telegram, and it's free. So you can join in the description below and come be a part of that community. I do daily market updates every single day with just the most important stuff, because there's so much noise in the market, so many YouTube channels, so many X accounts. I wanted to distill down the information to make sure that you have a very clean signal in the market. Now let's get into my plan. The first part of my plan isn't really an exit clause, but it's the foundation for how I'm laying out my portfolio. And because I've laid it out this way, it makes it a lot easier to manage risk. And this is the two portfolio system. So I don't treat my portfolio as one. I know a lot of people just have this big portfolio that they buy and hold and they chop in and out of positions within a portfolio, but I don't believe this is the correct mental framework because it leads to over trading, and it can also conversely lead to overholding. So what I do is I split my portfolio up. 50% of my portfolio is in long-term positions. These are positions like Bitcoin, Ethereum, Chainlink, Solana, Hyperliquid, Tau, that I'm pretty sure are going to be here for many years or many cycles. They've proven product market fit, they've proven attention and mind share, and they have a big enough solidified community that they can be here for many years' time. Now, that doesn't mean that I won't take profits on these assets. If Bitcoin goes crazy, and we'll talk about some of the triggers later in this video, then obviously I'll want to take some profits on my Bitcoin. If ETH goes crazy, I want to take profits. If Chainlink goes crazy, I want to take some profits. So just because it's a long-term portfolio doesn't mean I'm completely absolving myself from profit taking. I'm still going to take profits, but it is a long-term portfolio. So my goal is to continue to grow this over time. So there'll be periods where I cycle out, but I won't be ever fully cycled out of those positions because you also don't know how high they can go. Bitcoin can give you a fake out. One of your exit triggers could hit, but you never know. The market could have another catalyst to keep going up. Some new legislation or money printing or some risk on catalyst could hit the market, and then you can instantly, be priced out of your position. So I think it's important to keep some exposure long long term, no matter what happens, especially in assets like Bitcoin and Ethereum. The other 50% of my portfolio is short term. So my short term portfolio is where the majority of my degen stuff is housed. So any altcoin trades, short to mid term, even any altcoins period that I'm holding, I probably have in my short term portfolio, unless they're the big cap ones, because the majority of these, they're great to make money while the cycle's hot, but even if the asset has product market fit, you probably still want to exit. I'll use ENA and PENGU as examples, like these assets which I've recently added and are doing quite well for me, but I still don't think I want to hold Athena or PENGU for multi years. Maybe there's a chance I would hold on to a little bit of my PENGU if it really exhibits product market fit and I start to see the brand growing bigger and bigger and bigger, but I still think even still in a bear market would probably get hit by 80 or 90%. So I think a good framework to have is operate on the base case that every altcoin is going to go to zero. Anything better than that is a bonus, but operating on the base case that altcoins are going to go to zero means that you are hardwired to actually look at taking profits or selling those positions as opposed to bag holding them. So in the short term portion of my portfolio, my plan is to exit as much as possible. Now, I'm never going to time the exact top, and just like you'll never time the exact bottom in the market either, but my plan is to be a lot more aggressive with my profit taking in that 50%. And out of that 50%, usually I'll keep roughly half in stables, at times a little bit more, and then I'll cycle into high conviction trades when I see an opportunity in the market, and then I'll aggressively take profits back into stables, and I'll kind of play around with that portfolio a little bit more. I think the problem with most retail investors is that they treat their entire portfolio as like my swing trading portfolio. So they'll chop in and out of their Bitcoin, in and out of their ETH, in and out of their SOL. I think you should be able to do that if you have an edge in the market, but just by splitting them up and running a dual 2 portfolio system, I at least have some sort of mental and visual separation over my portfolio so I don't get confused. Pro tip, you can also break down some positions into each portfolio. For example, you can have some Bitcoin exposure in your short-term portfolio, and then you can have some Bitcoin exposure in your long-term portfolio. Like there are some ads recently that I've publicly made, like Bitcoin at around $111,000 to $112,000. That position is more of a swing trading position. So I'm holding that to the new break and the eventual all-time high. I'm not holding that forever, whereas I have another Bitcoin position, which I bought for, I think, $52,000 and then again at $78,000, and my plan is to hold that pretty much forever. So I also differentiate even between one asset, and you could do the same for Solana. You could have a little bit of Sol that you keep forever, or, you know, intend to keep for longer, and then have a little bit of Sol that you're willing to trade in and out of based purely on the charts. So how do we actually take profit? Now we've discussed how I'm setting up my portfolio. How do you actually sell? So the first point I want to make is in the short term portion of my portfolio, I'm selling all the time. You know, every time there's a bit of strength or, you know, a crazy pump, I'm looking to cycle profits back into stable coins because there's always another opportunity around the corner. I don't really have FOMO in the crypto market anymore because I know on a daily basis, on a weekly basis, because I'm so plugged into the market, that there's always going to be a new opportunity. So I'm often happy to actually sit heavier in stable coins and just wait for an opportunity, because that liquidity is extremely valuable when an opportunity comes. Now you might make the argument, oh, what if the market just rips to the upside and you're sidelined heavier in stable coins? Of course, that is a risk you take if you play that game. However, if the market does pump and if the market does break out, that means conditions are bullish. That means there are even more opportunities to profit. So if you're missing a lot of opportunities, that means that there are a lot of opportunities flowing around you, which means there are more opportunities that you can catch. So having that mindset allows me to be a little bit more comfortable when maybe I'm not fully exposed, but the market's ripping. I have more liquidity to take advantage. And then you'll see, you know, a big leverage flush. Now that I actually have money during the dip, everyone else is panicking. I can go in and I can bid on that flush and get a pretty quick reversal trade, which is a very profitable strategy in a bull market. But if you're fully invested, you can't take advantage of those opportunities because you know, if you don't have any liquidity, how can you have limit orders set? So honestly, at this stage in the cycle, I'm sitting around 50% stable coins. I'm going to explain later in the video exactly why I'm doing that, because I think people that are too overexposed right now, like above 80% in terms of their crypto holdings versus stables, I think you're missing a very key factor about the cycle, which I'm going to get into. So in terms of taking profit, I'm always looking to incrementally ladder out as an asset goes up. Now, what you can do is for a specific altcoin, actually have a laddering system. And this often happens when you buy the asset. If you haven't done it, that's fine. You can do it retroactively now, but it's best to do when you buy an asset. So let's say you buy an asset at $1, you would have predetermined levels where you take percentage profits out. So if that altcoin hits 120, I take 20%. If it hits 150, I take another 20%. If it hits $2, I take another 20%. And this can be based on resistance on the chart, or it can simply be based on a predetermined percentage level based on the riskiness of the altcoin. Obviously, a risky low cap meme coin, you're not going to be taking money out every 10 or 20%. You might take your initials out at a 2x and then at another 2x, because it's low market cap, it should go up more. You can be more aggressive with your profit taking. Take 50% of your position every time it doubles. Whereas an asset like Solana, clearly it's not going to double as readily. It might double once for the cycle, but it probably won't double beyond that. If it does, it means we're in a crazy old season. It means we're making a lot of money, but it probably won't double. That's the first thing. So as an asset goes up, ladder out. The second thing you want to do is you want to have an invalidation clause to the downside. And this is very powerful because this is essentially how you're going to protect yourself against bag holding throughout a bear market. So just as you have a ladder out plan to the upside, you should also have one to the downside. What I do is I have a predetermined high time frame level that's significant on the chart combined with a momentum indicator. So it could be the 200-day moving average, which is a great one, or as a high time frame confirmation, a weekly moving average, and I will have a clause where I sell a percentage, so let's say 50% of my Solana, if it drops below the 200-day moving average for 3 days in a row, something like that. That's protection against the momentum of an asset souring, because I don't want to be on the wrong side of an asset when it starts to downturn. So I think the proper exit strategy in the market for altcoins isn't a blanket approach, like when it hits this amount, sell everything. It's a combined approach. It's okay, as it's going up, you ladder out slowly, you go into stables. Pro tip, actually go into fiat, because it's harder to on-ramp than off-ramp again. If you keep your stables in a brokerage, you're going to end up gambling it again. Keep a little bit for limit orders and stink bids, but don't gamble it again. And then the second thing you want to do is have the invalidation clauses to the downside. It's even better if you've predetermined these when you enter the trade, but even if you haven't, you can retroactively define key levels, high time frame horizontals, as well as momentum indicators. And you can have a trigger with both, by the way. Pick the one that you like, as long as you have something in place. Something's better than nothing, by the way, because most retail, they don't even have any awareness of this, right? They're buying assets on their Bybit. They don't have any sort of invalidation. They don't have any sort of TP plan. So they're just going in blind. The very fact you're watching this video, and even better, if you actually act on this video, you're already ahead of 99% of people, because 99% of people don't manage risk absolutely at all. So the fact you're doing that is, I think, a huge credit to you, and you're going to go a lot further than most people. Now, final section, very important section, how to approach the market right now. So I do believe we're mid to late stage in the cycle, and that's purely based on the fact that we've been running since November 2022. We've pretty much been up only. We've had dips, but we've been going up for a long time on Bitcoin and ETH. And, doesn't matter what you say, Bitcoin and ETH lead the market, right? It's not the altcoins. So once they hit their cycle peak, once they cool off, altcoins are obviously going to get hit because they're more reflexive. Good news is I still think that there's more upside on Bitcoin and Ethereum. But I do think it's late stage in the sense that on Bitcoin, you're probably looking for that move from 120 to 140, 150. And on Ethereum, you might be looking at 6 to 7K, but percentage-wise, that's much smaller than the run that's already happened. Bitcoin from 15 to 120, and then Ethereum from $1,000 to local peak 4,700, 4,800 almost. So they've already done the majority of their multiples, by the way. So that's why, objectively, we're mid to late stage. Unless there was some sort of crazy super cycle. Look, I'm all for it if that happens. We make a lot more money if that happens, because we'll have liquidity to trade it, but and take advantage of opportunities that arise because of it. But that's not my base case. So my base case is that we're mid to late stage, verging on late stage, and because of that, I think it's very important to reframe how you think about risk. Now, most people have it completely wrong. Because the majority of gains are made in the last stage of the cycle, they take that as an excuse to risk more of their capital. But what you have to understand is that at the end of a cycle, that's also the riskiest time to trade and invest because volatility is at its highest. And unless you're really able to cope with that volatility and you're a really seasoned trader, that's the easiest time to get completely blown out of the market, because it's the easiest time to get bad entries, and it's the easiest time, especially on leverage, to get wrecked and wiped out of the market. So what you actually should be doing is the opposite of what your intuition says. If you think we're late stage in the cycle and we're heading to that blow off stage, you shouldn't have more capital risk. You should actually risk less capital. But to capitalize on the late stage of the market, you should move up the risk curve and get into riskier assets. So in the beginning of a bull market, just coming out of a bear market, you want to be allocating more capital to safer assets. For example, more of your portfolio to Bitcoin or Ethereum. As you move later in the cycle, you should be allocating less of your capital percentage-wise to riskier assets in the market. So you'll probably see me, if you're following me on the channel, over these next few months, degenning a lot more, getting into a lot more rubbish trades, making a lot more risky moves. But the huge caveat to that is I'm doing it with less of my portfolio. As I mentioned earlier, I have 50% of my portfolio in stables. I was publicly at 20 to 30% 1 to 1.5 years ago. So that's been already a big shift for me, and I'll probably go even further to 60, 70, 80% as we continue to progress here and as Bitcoin and Ethereum goes up. But what I'm doing with the remainder of my portfolio is a lot riskier. Implementing tactics on lower cap altcoins, beta plays, etc. that I simply didn't have to do earlier in the cycle, and probably wasn't optimal earlier in the cycle from an allocation perspective. So understanding that you should be dialing down the risk at the end of the cycle, but upping the risk in terms of assets you're allocating to, I think is the real key to succeeding in the late stage of the cycle. And this is something that all the best investors do in the market. And that naturally, as a byproduct of that strategy, forces you to hold more stables, which, as I said, exposes you to more opportunity in the market when opportunities do arise. Because, it's funny, people think you don't need liquidity in a bullish market, but bullish markets are actually when you need the most liquidity, because that's where there's the most opportunity. Like Chainlink last week, a bit more than last week, actually almost 2 weeks ago, I took a big position on the breakout of $19, right? That was a key weekly level, which had finally reclaimed. Took a position at $19. I didn't know that was going to break out. 1 week earlier, I didn't factor that into my equations at all. I obviously had stable coins, so I knew when an opportunity did come up, I would use that to deploy, but I didn't know what that was. 1 week later, the Chainlink trade got validated and I put a significant amount of capital into it. And then it ran to, I think at its local peak, $26, which, was a great swing trade on a big spot position. I also took a leverage position as well in tandem with it under different variables. So that was an amazing trade. I didn't even know I was going to hit that trade. And next week, there could be another amazing trade that I don't even know it's going to come around. I don't know. Tomorrow, someone could text me an amazing low cap that I didn't even know I was going to do today. So I guess the thing with crypto is that there's always another opportunity. And if you don't have liquidity and a big, amazing trade setup aligns, how are you supposed to take advantage of it? Well, the only way would be to sell other coins, potentially at a suboptimal time, to fund your new trade. So I'm not afraid at all to hold more stables. And that's where this whole dialing down the amount you're deploying, but dialing up the risk curve strategy actually comes into play. Remember, if you do want live updates, so every single day, with what I'm doing and a basic overview of the market to help you cut through the noise, I'll leave a link in the description below to my free Telegram, especially if you're watching this video later or whenever you're watching it. Really, that's going to be extremely relevant because things may have changed from recording this video, and I may very well be implementing the plan and the points that I've discussed today in real time, whether it be deploying more capital or whether it be actually continuing to shift more into stables progressively throughout the cycle. So if you want live updates on what I'm doing, when I'm doing it, link in the description below. Join the Vault, which is my private Telegram. It's free, and I'll see you in the next one. Make sure to subscribe for more content like this if you do enjoy these style of videos. See you later, guys. Peace out.